Hello, everyone. This is Phil Yaeger, and this is Yaeger CPA Review. And we are doing today regulation, and we're going to the business law. And there are some subjects that people have trouble with, one of which is secured transactions. And it's because of the terminology, that's one thing. And also, all right, they don't understand that what this chapter is all about is that you have two creditors, all right, and you have a debtor. And the debtor defaults on payment to both creditors. And basically, you have to determine in that contest between the creditors who has first rights to the collateral. And if you know that, you should be able to answer any question on secured transaction. Now let's talk about, first of all, one term that you see, and the word is attachment. Attachment is nothing more than a fancy word for the creation of the secured transaction. All right, when there's attachment, there's a secured transaction created. However, there's certain requirements for there to be attachment. All right, now one of them is, and here's my mnemonic I use. I use Dr. A.V. All right, now let's go to the A first. There has to be an agreement between the debtor and the creditor. And the agreement has to be signed by the debtor only. All right? And that agreement, if it's in writing, is called the security agreement. All right? Now, you need a written security agreement. Did I spell agreement wrong? I think I did, didn't I? A-G-R-E-E. No, that's right. Is it? All right. You need the security agreement signed, all right, when the creditor does not have possession of the collateral. But if the creditor has possession of the collateral, you do not need a written security agreement. That doesn't mean that it cannot be created, but it's not required. Now, also, all right, DR says the debtor must have rights. DR, debtor has rights in the collateral. Now, what does that mean? When does the debtor have rights in the collateral? Well, all right, the debtor will have rights in the collateral basically when the debtor takes possession, all right? And that's the last step normally you see when there's a attachment. So remember, all these things have to occur before there's attachment, all right? And also, the creditor must give value. That means that the creditor must either give the debtor the money to buy the collateral or extend the credit to buy the collateral. So let's look at these again. All right. First of all, you must have all three before there's attachment. All right. And they are the following. Dr. A.V. The debtor must have rights in the collateral. And usually that means the debtor has possession of the collateral. All right. There must be an agreement, which means there must be a written security agreement if the creditor does not have possession of the collateral. And the written security agreement has to be signed only by the debtor. And also, the creditor must give value. The creditor must say, hey, I'm extending you the credit to buy that asset, or here's the money to buy the asset. Now, I want to say it again. All three are required to have a secure transaction, but usually the last step, all right, and when you see this last step, usually that's when attachment occurs. And the last step is this. The debtor has to have possession of the collateral, all right? So you can have the debtor sign an agreement. You can have the creditor extending the credit, but until the debtor really gets what? The possession of collateral, there is no secured transaction. All right. Now, the next thing is this. Attachment is really where, all right, when the debtor signs that security agreement, the debtor is saying to the creditor, if I default on the payment, you and only you have first rights to the collateral. However, all right, no other creditors know about this agreement because the security agreement is not filed anyplace. So actually, all the security agreement does is basically, all right, tell the creditor, and the debtor only tells that creditor, hey, If I default to you, you have first rights to the collateral. But remember, there's going to be a contest with other creditors, and the security agreement is not filed anyplace. So therefore, other creditors who actually take that same collateral back on money extending to the debtor, all right, do not know that I am another creditor. Well, I'm the debtor, all right? But the point is this. If you're a creditor and there is a security agreement signed, all right, remember, I am saying to you, I'm the debtor, I'm saying to the creditor, by signing that, you have first rights to the collateral if I default. But usually in the agreement it says that the debtor will not use that collateral on another loan. But you know what? The debtor doesn't care about what it says. The debtor goes to another creditor and also says, hey, I got this collateral, all right, extend me credit. So now we have two creditors. Now remember, all right, the security agreement is not filed anyplace, so that second creditor does not know that the first creditor has first rights to the collateral. All right, so attachment only gives notice between the debtor and the original creditor that that creditor has first rights to the collateral. All right, but then we talk about, all right, what do we call it when, all right, creditors out there, all the creditors know who has first rights to the collateral. And that is called perfection. Perfection is basically where all creditors know who has first rights to a specific collateral. All right, now, you have to know there are various ways to perfect. Obviously, if the creditor has possession of the collateral, all right, possession is one form of perfection. And usually, that works when the collateral is negotiable instruments or stocks or bonds. All right, that's the way you perfect by possession if the collateral is negotiable instruments, stocks or bonds. Now, you can perfect by filing a financing statement with the appropriate state agency. Now, what this does is it puts public notice, all right, so that all creditors, theoretically, if they extend money to you in as collateral, they have to go to the state offices, all right, state agency, and see if there's a financing agreement, all right, which shows who has first rights to the collateral. All right, so that's what the financing statement is. And by the way, the financing statement has to be signed also by the debtor. And then we have the last type, which is perfection by attachment. Now, this is very limited. And let me explain what this applies to. Perfection by attachment only occurs when the collateral is consumer goods. All right? So, what happens is, if I go out and buy consumer goods, like a refrigerator, a washer, dryer, that's a consumer good. All right? So, if I buy consumer goods, what happens is, the minute the secure transaction is created, there's attachment, and then there's immediate perfection. So perfection by attachment only applies when the collateral is consumer goods, all right, and the person who's giving you the money to buy those consumer goods is a purchase money secured creditor. Now, here's a new definition. What is a purchase money secured creditor? That's a creditor that gives you money or extends credit to buy that specific collateral. Okay? Now, we have another type of creditor. All right? You see these advertisements on TV. Hey, you need some money? All right? Bring your car in, give us the title, and we'll extend your credit. All right? Now, they are not purchase money secured creditors. Why? Because the collateral, those, places, extending credit based on your car title, all right? They're basically taking back as collateral existing property. In other words, that car was already bought from someone else. So, when you take out as collateral existing property, all right, and that creditor does not give you the money to buy that collateral, all right, we call that a lien creditor or a non-purchase money secured creditor. Okay? All right. Now, the big thing in this is, all right, when there's a dispute between two creditors, who has first rights to the collateral? All right, now normally, all right, whoever perfects first, all right, generally has first rights to the collateral if the debtor defaults. And always on the exam, the debtor will default to both creditors. Why? If he only defaults to one, all right, then that one will go after him. All right, but it's always going to be the contest. The debtor is going to default to two creditors. All right, now let's talk about that contest. All right, first of all, we have this scenario. We have a purchase money secured creditor, all right, who gives money or extends credit to the debtor to buy equipment. Now remember, the type of collateral is determined by the debtor's use. So the debtor uses that as equipment. Now, this purchase money secured creditor gave the debtor the money or the credit to buy that equipment. However, the debtor then goes to a finance company. All right, we used to call this like household finance, and says, I need $10,000. All right, now, I need $10,000. The finance company says, all right, do you have any existing equipment? The debtor says, yes, I have this equipment. So now, household finance is a non-purchase money secured creditor and has taken back as collateral existing equipment. All right, now, let's assume, now by the way, whoever perfects first normally, all right, has first rights to the collateral if the debtor defaults to both creditors. All right, now let's assume that household finance, all right, filed a financing statement all right, before the purchase money secured creditor. In fact, the purchase money secured creditor has not filed. All right, now, what does it say in the law? Whoever files first, if they default, the debtor defaults to the purchase money secured creditor and to the household finance, which is the non-purchase money secured creditor, who would have first rights to the collateral if the debtor defaults to both? Well, whoever filed first. Who filed first? HFC. However, the law says this. The purchase money secured creditor really gave that debtor the money or extended the credit to buy that collateral. So we will still give the purchase money secured creditor, all right, actually, if they do something, they will have priority over the collateral, even though the other creditor filed first. Now, what does the purchase money secured creditor have to do? Well, it depends upon the collateral. Now, let's assume that it is equipment. All right, what does the purchase money secured creditor, all right, have to do to have first rights to the collateral, even though they filed after the non-purchase money secured creditor? Well, the UCC says that they have to file within 20 days after the debtor gets possession. All right, so if the purchase money secured creditor files a financing statement within 20 days after the debtor gets possession, then what will happen is this. Even though the non-purchase money secured creditor filed first, the purchase money secured creditor did the right thing according to the UCC. They filed the financing statement within 20 days after the debtor gets possession. They filed second, but even though they filed second, if the purchase money secured creditor does the right thing, then they have first rights to the collateral now. Okay? All right, now, what happens if the collateral is inventory? All right, what must, all right, here we go again. The purchase money secured creditor did not file. All right, now, let's just take this out. And we know the collateral now is inventory. All right, and now what happens is, once again, all right, the debtor goes to household finance, who's a non-purchase money secured creditor, and says, I will give you a loan as long as you have collateral. The debtor says, I have inventory. Now, of course, the debtor doesn't say, I purchased it from a purchase money secured creditor, because then this household finance would say, no way am I going to lend you money and take back collateral that is also collateral on another debt. All right, so household finance files a financing statement when they actually create the secured transaction. All right, and then now they have first rights to the collateral because they filed first. The purchase money secured creditor has not filed. Now, what does the purchase money secured creditor have to do to still beat out the household finance company even though they filed first? Well, the UCC says this, all right, if you purchase inventory and inventory is the collateral, all right, this is what you must do. First of all right, the creditor, all right, must notify the non-purchase secured creditor who filed first. All right, now you say, how would they know to notify him? Well, remember, household finance filed the financing statement. It's in the public record. So therefore, all they have to do is go to the public record, all right, and do what? All right, see who filed. And then, once they find that out, all right, they can notify the household finance company that they were a purchase money secured creditor, and they extended the debtor, all right, the money to buy the inventory. And then, what else must that debtor do? Now, the first step, we said that the purchase money secured creditor has not filed yet. All right, they have to notify the non-purchase money secured creditor who filed first that they lent the money to the debtor to buy the collateral, the inventory. And the second thing that the purchase money secured creditor has to do now is file a financing statement. Now, even though it is after, all right, it is after the debtor has the collateral and all that, it makes no difference. All they have to do is, now, the purchase money secured creditor has to notify and file a financing statement, and now the purchase money secured creditor will have first rights to the collateral if the debtor defaults to both, even though the non-purchase money secured creditor filed first. Okay? All right. Now, remember that. Now, a lot of times, what they'll have is this. Instead of a purchase money secured creditor, all right, and a non-purchase money secured creditor, like household finance, they will have a trustee in bankruptcy. All right, the debtor has filed bankruptcy. So now we have a trustee in bankruptcy, and obviously the trustee in bankruptcy is going to take that inventory from the debtor, all right, because the debtor is going through bankruptcy. But then we have the purchase money secured creditor. All right, now, if the debtor defaults to the purchase money secured creditor and the trustee in bankruptcy takes the inventory, who has first rights? Well, look at the trustee in bankruptcy also as a non-purchase money secured creditor. And if the purchase money secured creditor does the right thing, all right, make sure what the right thing is for inventory and equipment, then the purchase money secured creditor will get the collateral back from a trustee in bankruptcy. Okay? Now, also remember this. When you purchase something from a department store, you're considered a buyer in the ordinary course of business, and also the department store who sells merchandise on a full-time basis is considered a merchant in the ordinary course of business. Now, the department store probably bought that clothing on credit. And if they don't make their payments to the company they bought it from, theoretically that company can actually show up and take those goods back. But who has the goods? You have the goods. You went into the department store, you're the buyer, the merchant is a seller in the ordinary course of business. All right, now what happens? Well, if you buy goods from a merchant who sells goods in the ordinary course of business, all right, you are not subject to the liens of that merchant, which means if the merchant defaults on his payments to his creditors, the creditors cannot show up on your house and say, give me back the goods. All right, can you imagine you're watching a TV set, you bought it from Best, all right, and you're in the middle of the Super Bowl, all right, the team that's losing is on the 5-yard line, ready, and then the creditors show up from Best and say, give me back that TV. All right, now what are you going to say? Well, luckily, I took that business law course with Phil Yaeger. And, you know, Best is a seller of goods in the ordinary course of business. And I bought those goods from Best, a merchant in the ordinary course of business. And you know what? I don't care about their liens. If they didn't pay you, that's not my problem. Okay? All right, just remember that. That's an exception. So, those are the key things you have to know about secure transactions. The terminology, attachment, perfection. All right, what are the ways to perfect? All right, and if you have collateral put up to a purchase money secured creditor and a non-purchase money secured creditor, if the non-purchase money secured creditor files first, what does the purchase money secured creditor have to do to still beat out the non-purchase money secured creditor and get the collateral back from the debtor who defaulted? That's what you have to know. So anyway, I hope my example helped you. All right. Once again, look at some questions. All right. In our book, whatever book you have, and hopefully, all right, you will understand secure transactions. Thank you, everyone. Take care and have a nice day.